300 points. What are the key triggers that we're watching out for? The first thing will be the third quarter results and the management commentary, pre-budget conversations with regards to vote on account, etc., global markets and yields. And the other thing that we'll be watching out for is how the mid-caps fare, largely because at the start of a series, we have one stock in F&O band, that's Hindustan Copper, after a big move that we saw yesterday. And usually that does not typically happen.
Okay, all right, Mangalam got that. Thank you very much. Hindustan Copper has been quite the star of December. Just about 20 seconds to go. So the opening could perhaps be on the negative side, and that's in sync with what a lot of Asian markets are doing. There's some profit taking pretty much across the board. It has been quite a stupendous week for the market so far. So perhaps we start out a little soft. The Bank Nifty is the one to watch. Can the dip get bought? Because right now the Bank Nifty is indicating a negative start to about 0.25% or so. So that's, of course, something that we will keep in mind, as well as stocks like Reliance, where the top leadership has given out a lot of commentary and expectations on 2024. Okay, we kick things off with a 40-point decline on the Nifty and about a... so it's in sync. The decline on the Nifty and the Bank Nifty right now is absolutely in sync. 0.25% down on both of those indices. Mid-caps have started out slightly positive. Where is the lag coming from on the large cap space? BPCL, Coal India, SBI. These are some of the PSU names, the large cap PSU names that have started off with some profit taking. Then you've got Infosys, which is starting a little lower. HCL Tech is down, as is HDFC Bank. So banks, again, are responsible for some of the ease off in the morning. Kotak is down about 0.5% as well. So banks subdued, some of the PSUs looking at profit taking. That's how it's playing out. And IT also on the weak side as we kick things off. TCS is down, for instance, about 0.2%. On the flip side, Adani Enterprises, Adani Ports, some of the Adani stocks are looking good. Reliance has reacted positively, about 0.2% up on Reliance. But it's a little quiet, you'd have to say. Just around 50 points lower on the Nifty. But I guess we can't complain, given the year and the week. This is perhaps par for the course.
The mid-cap index is absolutely flat to begin trade with. Some of the stocks which are in the news, Saturn Credit Care opens with a gain of 4%. They've entered into a co-lending agreement with Karnataka Bank. Realtel has a gain at opening 3% higher after bagging an order worth 120 crore from the South Central Railway. RBL Bank, Federal Bank are some of the stocks on the banking side which are higher after RBI has given a nod to RBI Pru AMC and Pru to acquire further stake in these banks. On the losing side, ICICI Lombard is under pressure, 1.5% off the bat lower after it gets a tax demand and a penalty notice amounting to 1,900 crore rupees. Fairly sizable, and the stock it has opened with a cut of about 1.5%. So these are some of the stocks which are in the news. On the losing side, apart from that, you've got oil marketing companies. So we spoke about BPCL, but there are cuts on HPCL and IOC too, 2.5% lower. And this follows a 17% gain that we've seen for oil marketing companies in the month of December. Some of the PSU banks are seeing some cuts. So Bank of India is one stock on our radar. On the gaining side, you've got a Kalpataru project, smart 8.5% up move on that. EIL is seeing some buying, and Hootco is in the green. No big gains, but at least the gains of the last couple of days are very much intact there.
Okay, well, you know, it's a down day. It's a down start, rather. I mean, we're down about 60 points now on the index. 21,717 is where we find ourselves at. Take a look at the Nifty Bank. Quick look there, and I think it should be following what the Nifty is doing as well. About a third lower. So just a few other names in the broader market. So the big volume-led gainer this morning is Sona Comstar, which is coming up with a 2.5% gain. Stocks at about 646. There is Mazgaon Dock, which is coming up with 1.6% gains, 2,321 in Mazgaon. Kalpataru, Rima mentioned. Kalpataru, by the way, we have the management joining us a little later on the show. 715. It's got large volumes at this point in time. Azad Engineering, which is the listing from yesterday, ended 30% higher. That starts another 4% in the green, with stocks past the 700 rupee mark once again. IEX starts about 2% higher. Venus Pipes, I mean, that's another name. There's a new initiation on Venus Pipes. Stocks up 6%, 1436 on that one. There is Aarti Industries, which is up about 2% or so. So this is the volume-led list that we want to get to you. Tata Consumer is up about 3% as well now, and it's got decent-sized volumes. Market breadth is, I mean, I think it's settled now. 900, I think 1,000 up, 900 down is the kind of picture. HP, which went up 10%, HPCL, which went up 10%, is down about 2.5%. BPCL is down 2.6%, and IOC is down 2%. So oil marketing, that is seeing a bit of cool off. It's been a frenzied run in the oil marketing pack that we've had. And there is India Mart, maybe we can look at, which is down a little bit as well. And Go Colors, I think we mentioned this. Go Colors is down 6%. Stocks at about 1,212 rupees or so at this point. So that's the overall picture. Market down about 60 points. We'll come back with more names in a bit from now. Andrew Holland is with us now, Chief Executive Officer at Avendus Capital Public Markets. Andrew, great to have you with us here. Thank you very much. So as we enter 2024, we'll have to get through January. And the reason I say that is because January seasonally, and I was putting this out in the morning, 12 out of the last 16 Januaries have been down. So there is a bit of seasonality there. I think it matters if you're trading. I mean, if you're investing, you can look past it because otherwise the overall picture looks pretty okay. Pretty good, actually. I mean, some of the fundamental drivers, etc. But if you're trading, what's the advice from here, Andrew?
I think it's going to be a choppy first few months, actually, Prashant, because I think, if you look, all the positives we know, right, in terms of interest rates, the Fed pivot, everything's there. But the market's kind of very quickly rushed and priced everything in. So there's no kind of room for any kind of error in this in terms of, if there's an escalation in the Middle East, if the Federal Reserve kind of delays, doesn't do a rate reduction in March, but leaves it till June. The market's just saying, no, it's all baked in, it's all done, and we're kind of off to the races. So whilst I'm not trying to pour cold water on the market moves recently, I think January will be a lot more volatile because I think some of these things will be tested. Will test the market's resolve in terms of that Goldilocks scenario. So been great year end for all markets. But I think if it can consolidate, Prashant, in January around these levels, it'll be a victory because I think if anything we're getting into that overbought zone, which usually there'll be something that brings the market down in the very short term.
So are you fully invested or not, Andrew, as you enter 2024 in your portfolio? Or are you keeping some cash in case the markets drop, you will go out and buy?
Yeah, no, we deployed. Fortunately, going into the back end of November into the elections, and then throughout this month, we've been luckily very, very fully invested. I think as we start to see the market consolidate, then we'd probably take some more money off the table, and then look for those opportunities, which I'm sure will present themselves in January fully for us.
And where might these opportunities be? Andrew, good morning. Surabhi here. Season's greetings to you. The question is, where could the opportunities be? In the same sectors, the same kind of stocks, industrials, PSUs that have done well? Or do you see some dark horses out there?
Well, I'm not sure there's any dark horses to which have got any value. Maybe chemicals might be the only one, but I'm not tempted there. No, I think, so if you look at what we're saying, right, we're saying that interest rates are going to fall in the first quarter, by the end of the first quarter, and then maybe the RBI will follow suit in April. If that was the case, then obviously the banking sector still has a further leg to go. I know the RBI is at the sidelines worried about unsecured loans, so we have to kind of watch the regulatory part of that. But obviously, if interest rates are falling, NIMs come under less pressure, and corporate capex will start to pick up. So I think that bodes well for the banking sector. So I think that will be one of the drivers, along with metals and IT. So I don't think anything else is going to take us away from those three kind of sectors driving the market higher, particularly if foreign investors come in. They're going to come for large caps, and they're going to go for these three sectors because they're all interest rate sensitive, and because the dollar would likely kind of weaken in that scenario, metals will do well. And of course, we're all awaiting, and let's see if it happens, for some further stimulus from China, which again would have a great impact or positive impact for the commodity prices.
So, Andrew, so banks, then, I mean, names like HDFC Bank, which are just now getting back to their previous highs, that's where the money is going to come into?
Yeah, no, into the large cap banking sector, yes, for sure. I think whilst I'm not kind of going away from mid caps and small caps in terms of a theme, I think it's the themes which will play out, which lend itself to some of these stocks. So, for example, I've been talking to you many times about premiumization in the beverage industry. So there's many companies out there which will benefit from that, which would be in that kind of mid cap kind of sector. But I think if FII flows come in, if PI flow, foreign investor flows come in, then it's really going to be large cap where they'll kick off with their first investments.
You said you deployed money towards the end of November and through December. Do you want to tell us where you've allocated your money?
No, we've talked about this many times in terms of what would drive the market, and that would be obviously if after the Fed pivot, it had to be in the banks, IT, and metal sector. So those have been the drivers of the index. They've been the underperformers of the index as well up until recently. So it wasn't a difficult kind of thought process in terms of where the momentum would be. But also metal's been helped by what's been happening in China in terms of commodity prices there. I said, I think going into January it's going to be a little bit more volatile. We're pricing in perfection in terms of all of our forecasts, and the market's not sounding any kind of alarm bells in terms of what could happen on the downside.
Andrew, how have you positioned for this, the sectors of 2023? Have you played that whole rally in industrials and defense stocks and PSUs? I mean, my God, who would have thought that PSU stocks will return 100, 200, 300%? What do you make of it? And what would your advice be? Is it time to lighten some positions here or just keep on riding?
No, I think throughout 2023 have been, government spending on defense, renewables. So those themes aren't going away from us. Those will continue, for the next 2 to 3 years. So, there's still a lot of growth in those sectors to enjoy over the next 2 to 3 years. We talked about travel and the hotel industry. And again, I think that's going to continue to increase. The per capita GDP of $2,500 now means people want more experiences. So you'll see more travel. So airlines, hotels will be a continuous theme for 2024. And then two sectors we could have picked on in terms of new themes that we liked. And at the very beginning of the runway was the electronics manufacturing sector, where, again, domestically and export-wise, it's just going to be huge for these companies in terms of both profitability and revenues. Over the next 3 to 5 years, and they're all growing at 50% compound. And the premiumization in the beverage industry is continuing. We have a huge young population. They want to try many different things. So I think that again is at the beginning of the runway in terms of revenue growth and margin growth as people move up the curve in terms of what they would like to drink or eat going forward. So I think this is going to be a huge sector. So those are the themes that we've been playing and will continue to play. In terms of the PSUs, we've always said, Surbhi, that we like to rent these stocks, not really own them, particularly in the banking sector. And that's the kind of view and trading view we'll have on the PSUs.
You said you're not very convinced about the specialty chemicals theme, about it bottoming out as of now. Do you want to tell us about the rural sector and in terms of demand picking up, in terms of the themes which have not done well, where there has been a cycle downturn, has been IT, chemicals, and to some extent rural demand or consumer discretionary at the bottom end? Amongst these three, you're betting on IT. Specialty chemicals, you said you're not convinced as of now. What about rural consumption for 2024?
Yeah, it's a good question. It's a kind of a mixed bag at the moment in terms of the feedback we get, from companies and obviously from the brokers who are kind of writing reports on their travels. I think if I look at what I think the drivers for the economy and mainly earnings in 2024 is the multiplier effect from the government capex and private capex that we're seeing now. So across many different sectors. I think that to start filtering through to the rural economy, going into the second half of 2024. But I think I'm not banking on the rural economy to kind of pick up and have that consumption. I think there's enough, in terms of, like, say, the premiumization in beverages, which will continue and help earnings. So I'm thinking that earnings growth will be around 15% in 2024-25, and I think the market could probably be in line with that in terms of the returns as well for 2024-25.
Okay, all right. Andrew, good chatting with you today. I appreciate you joining in. Wish you a fabulous end to 2023. Have a fantastic New Year's. And of course, we look forward to more conversations in 2024.
Thank you, and wish you all a very happy New Year.
Thank you very much. Well, with that, we'll move on now to our next conversation. And the company that we're putting the spotlight on is Patanjali Foods. The stock has seen a pretty good run-up in the last 3 months. The company also held an analyst meet recently in which it set a group turnover target of 45,000 crores for FY24. Sanjeev Asthana, Chief Executive Officer at Patanjali, is joining in to talk about these plans, the target and the business outlook. Mr. Asthana, thank you for joining in. Season's greetings to you. So big targets there for the fiscal that will end out. 45,000 crore group turnover is what you're looking at. So tell us, what do you think will drive it? And give us a specific outlook on the edible oils business. How are your volumes shaping up there? And how much of this growth, this turnover, group turnover, will actually come in from the oils business? How much would be FMCG? Give us a breakup of the numbers as you see them.
Sure. So greetings to everyone at the CNBC-TV18. There are two sort of paths to the strategy that we have right now. One is we are pushing for increased turnover of the FMCG businesses, which is getting driven largely around the foods vertical at a group level, the non-food FMCG, the Ayurvedic medicines business, and there are a range of other businesses that the company runs, which includes dairy and a couple of similar adjacencies that we have in the businesses. The second part of the strategy is to continue and maintain the profitability in the edible oil business. So the target is not so much on revenue, but on running a profitable growth. So last quarter, we had done in the first half of this fiscal, nearly 28% of our business in Patanjali Foods side, which is a listed entity, was about 28% was FMCG. And the sort of the edible oil portion of it was about balance 72%. So the overall estimation is that, the edible oil prices are a big indicator of how much the revenue one will earn. So per unit value per ton is a big number which derives really in terms of the revenue side. We don't look much at it. Our volumes have grown about 28% last year, which is significantly higher than with the way country has grown. We expect this to sort of taper off closer to a regular run rate of between 4 and 6% on the edible oil side. Our foods FMCG businesses will typically tend to grow at about 15 to 16%. So the net estimation is that Patanjali Foods side, the listed entity, again, I'm repeating, should be closer to about 36 to 38,000 crores next year. And at a group level, certainly we should be closer to 45,000 crores plus as we close the year.
Okay. Getting back to the point about profitability, for the edible oil business, what is the outlook that you have for edible oil prices? Because prices have halved. Have you exhausted all your, high-priced inventory? When can you get back to those margins of 3 to 4% for the edible oil business?
So edible oil business, as you know, in last 4 quarters has had an extremely difficult time for most companies, and in fact, even the world at large. I think that is behind us. So this quarter, we should be reasonably better in edible oils in terms of the margin. Next quarter, we should be pretty much on a regular run rate. So I think even while the prices have halved, the profit margins have returned because the scale at which it slid has certainly tapered off, and I think the market is also ready to pay, for the value. The demand is back again in a quite a robust way. So my anticipation is that the imports in India will grow at between 3 to 5% this year. Our numbers this quarter, 6% plus is the growth we are expecting on the revenue side, and our margin construct between 2 and 4%. We should be pretty much back to the old ways of margin on the edible oil side.
2 to 4% for the full year or for Q4?
For Q3 and Q4.
Q3,
Okay.
Q4.
Mr. Asthana, good morning, sir. I understand you're not been keeping well, so just want to thank you for making the effort and being with us here this morning. Appreciate it. Prashant Desai and Seasons greetings, sir. Just a quick word on the foods business, which I think now is just under 30% of sales. Could you, what's the roadmap? By when do you, that business will keep growing? By when do you reach the 50% share, sir? Because that is what a lot of the street is excited about.
So we had, Prashant, already sort of declared that the roadmap was 5 years. In fact, we have moved way faster on that trajectory. So my estimation is that while we'll maintain the 5 years as a number, that our revenue of edible oil and the FMCG should be 50-50. But broadly, my estimation is that we would be able to surprise the street, probably that this number we could achieve faster. With a lot of sort of work which is going on right now in expanding our foods portfolio, our Nutrela, we're expanding the categories by adding a lot more, sort of making it to an umbrella brand and launching new products in that. And likewise, under the category of biscuits, our growth has been scorching. We're growing at 20% plus year on year. So our estimation overall is that we should be able to achieve this probably in between 3 and 4 years' time, with the addition of new categories and the organic growth that we are seeing in the businesses.
And margins in the food business, Mr. Asthana, what will it be on a steady state basis as you see it?
So a steady state basis, we have maintained that it should be 15 to 16% is what we estimate the margins would do. Because clearly it's a blend of, the categories, which typically some of them are very high margin categories and some of them are not as high. So on a blended basis, on the FMCG, we should be between 15 and 16%.
So, Mr. Asthana, we've discussed a lot about the business plans and how you're looking at growing all the verticals. Let's talk about the investments as well then. What is the outlook for the remaining part of 24, and as you're looking at plans for FY25? I believe the cash on books is around 2,000 crores. So just help us understand the investment thought process for the new year.
So we're fairly comfortable on the balance sheet. The cash is closer to 3,500 crores. And, in terms of the need for CapEx, the requirements are fairly minimal. Other than the regular run rate of maintenance CapEx of between 100 to 150 crores a year, we don't need any large-scale investments at this point of time. In year 25-26 and partially 26-27, we would require about 1,500 crores of investments, on which I think our free cash flows are fairly supportive. So I'm not anticipating any fresh requirement of funds really to, fund any of the CapExes that we have targeted right now.
So the targeted CapEx is 1,500 crore in the next 2 years, right?
Year three and year 4. The palm plantation business will come into fruition when we have to start putting the capacities for processing. Otherwise, our CapEx requires, we've got ample capacity to process edible oils in the foods business. There's enough and more requirements. So it's just a routine maintenance CapEx that we spend right now. And the basics
So
in the oil
we are talking about 3 years, 4 years down the line. Are you looking at some point of time demerging the FMCG food business and the oil business, the edible oil business?
So this gets discussed very often, and very clearly, the view from the investing community is that this oil business is not supportive of a large FMCG business. Where the view we have sort of explained repeatedly to investors is that the edible oil business on a margin basis looks low, but on return on equity, it's a very good business. So if once we get back into 3 to 4% margin each time, and are able to rotate the capital, about 5 to 6 times a year, It's a pretty much return on capital of about 15 to 18%, which is a very attractive business to be in. So right now, while the discussion keeps happening at multiple levels, but there is no plan to really remove the edible oil business from the company's portfolio or demerge it.
Okay, all right, Mr. Sana, we'll leave it there. Thank you very much, sir. Great speaking with you here on CNBC TV 18. Good luck as we look into 2024. And once again, thank you for making it today. So that's Patanjali Foods with a quick check on the business. Well, the markets are recovering. We're down just about 35 points. We were down about 60 points on the Nifty. 21,743 is where we are at right now. We'll take a quick commercial break here. I mean, coming up, one of the big winners of 2023, we speak with MCX. Lots to talk about there. The business momentum has been strong. Markets very excited about future prospects. A little later after that, we'll have the management of Make My Trip as we put the focus on holiday season and demand trends there. Stay with us.
CNBC TV18, embarking on a quarter century of excellence. CNBC TV18, embarking on a quarter century of excellence.
Welcome back. The markets are coming back up very nicely. And today, as always, at 9:40, we speak with the big winner of 2023. And we're putting the focus on MCX. The stock's up. Basically, it's doubled in 2023, 100% plus. We have Rishi Nathani, Chief Business Officer at MCX, joining us to discuss the future prospects of the company. Rishi, good morning. Great to have you with us here. Thank you very much for your time. Exchanges and capital market intermediaries are all the rage. Be it equities, be it commodities, but more equities and commodities. And the hope is your investors are hoping that, some of the magic of the very high P multiples on the equity side will rub off on the commodity side as well. So with that said, tell us, let's just talk about the business. The new software, which has been implemented now, has seen a few cycles of expiry. How is it holding up? Have you noticed any issues at all? Is everything working pretty smoothly? If you can talk to us about what volumes have been like, just the picture there.
Thank you and good morning, and wishing you all a very happy new year ahead. The technology transition has been very smooth, barring a few isolated issues which we have fixed and are also working in fixing. Our trading is absolutely smooth, and the turnover that reflects in the turnover, because go live, when we went live on 16th October with the new technology platform, which is the TCS, with the Deutsche Börse T7, and for the back end with the TCS banks. And the volumes post go live have been in fact higher than what we saw in this current fiscal. So overall, smooth sailing as of now. And I'm sure that going forward, the system will become even more robust and we could add more functionalities and features to it.
So the stabilization has completely happened. And could you quantify? Volumes have been higher.
Yes, so I'll just give you.
But because of the software, or they've just been higher, seasonality and things like that because of underlying commodities. Sorry.
Yeah. See, software is an enabler. So the
Correct.
volumes, the business is as usual. If the software wasn't working fine, the volumes could have seen a negative impact maybe. But the fact being that everything is smooth, so it is business as usual for us. So if you see in FY23-24, the overall volume till date has been in futures 20,354 crores, in options 81,220 crores. But if you see the post go live volumes, they have been higher than this. So you have seen 20,094 crores in futures and 87,842 in options. So overall, there has been a growth in turnover pre and post go live.
So, okay, Mr. Nathani, that's obviously on the operational side, how the new software is shaping up. Tell us about tech costs, because from a investor point of view, that has been the big concern, because your tech costs were substantially higher in the second quarter. Now, as the new software settles, and I'm not sure if you're renewing any other contracts of any other nature on software platform technology with 63 Moons. Just tell us what's the outlook going ahead. First of all, will there be any renewal of any sort of technology contracts with 63 Moons? And give us a guidance on the tech costs for the rest of FY24.
So as what I can say is that we have fully migrated to the Deutsche Börse T7 platform with TCS and for the backend with banks. So I do not see any reason why we would renew any other technology contracts. And accordingly, whatever the costs are with TCS are the costs we will have to pay going forward. Whatever we had to pay for the previous technology, we've already paid. So I think it's already behind us.
Okay, so can you just guide on this? Because, I'm just going back and looking at the numbers. In the previous quarter, your software expenses were up 55%. They were at about 135 crores. So purely from a cost standpoint, software, running costs, maintenance costs, etc., what should be the quarterly rate now that you have migrated fully to the TCS platform?
See, again, I will not be able to give you specific numbers, but what I can say is that now costs will stabilize and it will not be any out of normal expenditure on the technology platform.
Okay. You have also applied for approvals and renewals with SEBI for select products. Can you tell us where they stand, which are the products, and when can we hear back from SEBI granting you an approval?
Okay, so see, we always work on various products which we want to launch, and we approach the regulator as and when we are confident that we would want to launch certain products. We also had certain approvals in place, but because there was a gap due to the technology migration, we did not launch it earlier. So we are going for revalidation of certain contracts, and for the others, we will go for approval. So both are being done as and when we see the scope for launching new products. We approach the regulator, and once we get the approvals, we will definitely look at launching them.
Can you tell us which are the products where you're going for revalidation and which are completely new products?
Okay, so completely new products, say, for example, electricity futures. And then also mini contracts, say, which we are wanting to launch in, say, copper and nickel. Then you could also see we are launching a new steel TMT bar contract on 15th of January. So the steel TMT rebar contract is something which was required by the market, and we feel that there's a lot of scope in that. The cotton contract, we would look at bringing certain changes as recommended by the PAC, the Product Advisory Committee. And in the bullion contracts, we have certain approvals which we are looking to revalidate.
Okay, so this is all, this is the whole list of contracts, or where you're basically waiting for the final approval for launch? For the final
so as I said, so as I said, we already had approvals for certain contracts in place, but because there's a time lapse between the approval and we haven't launched it, so we are going for revalidation of certain contracts, and the others we have applied or are in the process of applying for getting approvals.
So 15th of January, you will launch the steel contract. Anything else you will launch in the fourth quarter?
As of now, it's only the steel contract which we've issued the circular for. And as and when we decide to launch, definitely we'll inform the market.
Some of the others could come in Q1 or 25?
See, I cannot give you exact timelines, but all I can say is that now, since the technology transition is behind us, going forward, we will be focusing on getting new products into the market, new contracts into the market, and focusing more on our business growth.
And just a basic question, for all these, when you launch, there will be the futures contract and there'll be the options contract as well?
So there could be futures, there could be, so for contracts, say for example, steel, where you don't have a futures contract, we'll first launch the futures contract, then basis the regulatory norms of minimum timeline and turnover, then we could look at launching options if we see that kind of, if we qualify, the contract qualifies for that. And where we already have successful futures, we could look at launching options as well.
You know, okay. So typically there is a gap between you first launch, I mean, there's no contract, you launch the futures contract, and then typically what is the gap between when some of these thresholds are met and you can introduce options contracts as well?
So it's normally a year one would look at, while there's no specific timeline for us to have to launch something, but we already have certain contracts. So for example, in options, we have options in gold, silver, crude, natural gas, and 2 base metal contracts. So there are certain other contracts we could look at launching options going forward.
How many products do you have right now where you're in the process of rolling out options for?
No, so as I said, we continue to study the contracts, and as and when we feel that there is some scope, we will definitely look at launching options.
Okay, so let me just put it down to numbers then. You said option turnover is some 81,000 crores, right? Or actually, it moved up to
87,000.
87,000, right? So,
yes.
Yeah. And you introduced options, what, about a year and a half ago, 2 years? When was the sort of rollout?
No. So the options were launched 5 years back, and for a couple of years, we did not see much traction. It
really picked up, yeah.
Last 3 years, we've seen complete growth in options, and the growth has been phenomenal in the last 3 years. For example, in FY 22-23, our options turnover was 34,000 crores, which is now up to 87. So we've more than doubled in a year.
So when does this near 1 lakh crore in options double? What's the broad number? I'm just asking you because you look at what has happened on the equities, right? 10 years ago, it used to be 90% futures, 10% options. It's exactly the reverse now. 90% options and 10% futures. So the growth there, of course, is much faster. So on the option side, I mean, if you can, and that's the great excitement for investors as well, if that were to happen. Could you lay out a roadmap broadly? What's the thinking?
Yeah, okay. So while I'm no astrologer, but 5 years back, our futures volume was almost 100%. And today, our futures volume is roughly 20%. So we are also getting there, like you said, about the equity markets. And we continue to do our work, and it's up to the market to reward us. So we go out, meet people, do awareness, launch good contracts, and do all that is necessary to make sure that business goes on and grows. And then it is up to the market participants to make sure that we get to 1 lakh, 2 lakh, wherever going in the future, wherever we may go.
Without dipping into the science of astrology, as you said, what's the growth rate you expect for this segment with the existing option contracts and the new ones that you will introduce? Broadly, roughly, in the ballpark, what should we expect?
I can only tell you what we have grown at, and then it's up to you to understand where we could go going forward. So I gave you numbers from FY 22-23, where our total turnover was 57,500 crores, with 23.5 in futures and 34 in options. Currently, we are doing 20.5 in futures and 81 for the full year. I mean, this current fiscal in options. So the growth path is there in front of you.
Rishi, I know you all have a near monopoly, but your competitor NSE is introducing certain products, commodity derivative contracts. How many products does NSE have which directly competes with you? And have they gained any market share? What are their volumes looking like?
Well, competitors are not here now. They came in 2018 when all the exchanges became stock exchanges, and all the exchanges were allowed to do various products. And in the last 5 years, I don't see anyone having got much traction. And in fact, our market share has only grown. So I would rather focus on our business and growing that.
Okay. I thought NSE introduced 13 new commodity derivative contracts on 16th of October 2023. And they had already allowed trading in WTI crude and natural gas futures from May of 23.
Yes, but the other exchanges launched other contracts since 2018. So you have all these contracts running, and there are phases when they bring new contracts or whatever. But as I said, our market share is intact. Our volumes are growing. So I'd rather focus on our business, and make sure that grows.
Is there any risk, as you see it, Rishi? I mean, it's like, the DRHP, you write, right? Risks, potential risks into the future. Again, I'm asking you to not predict the future. Like, for example, I'll tell you, on the equity side, occasionally, because option volumes have exploded to such a great degree, and I think we have the highest options volumes in the world on equities, there's this, at the margin, chatter whether, the regulator will step in and whether, things like that. I mean, to just curb what's happening there. In commodities, options, of course, are at their nascency in that sense, right? They've only picked up in the last 2.5 odd years. But that or any other kind of risks that you see?
Yeah, okay. So let me give you a very important differentiation between equity markets and commodity markets, in that then in equity markets, you would have investors, speculators, traders, etc. But in commodity markets, we have much more than that. We have actual end users, producers, consumers, exporters, importers, all these MSMEs, large corporates. So there is a large number of actual users who use the commodity markets to hedge and manage their price risks. So, risks are always there in everything. Without risk, no business is there which is completely risk-free. But having said that, it is all about risk management. It is all about making sure that the commodity markets, which is very nascent, continues to grow. And I believe that the regulator has always been supporting us and will continue to support, to make sure that India becomes a price maker rather than a price taker. And that could happen only if the domestic commodity derivative markets grow.
Rishi, we'll leave the conversation here for now. Thank you very much for joining in. That's MCX for you, one of the big winners of 2023. All the best for 2024. Well, we are in the middle of the holiday season right now, and 2024 is just a couple of days away. So let's talk about some travel plans then and the trends that we're seeing, the demand environment. Rajesh Magaw, the co-founder, group CEO at Make My Trip, is with us on the show. Rajesh, morning. This is Rima here. First question, right? What are the gross bookings looking like, say for this Christmas weekend and even for this October to December quarter, which is generally seasonally strong? What are the numbers?
Yeah. Good morning. Thank you for having me on this lovely foggy morning in Delhi. I don't know if you guys have experienced it or not, but it's quite foggy today morning, and it's actually a great setting for spending time out with the family, etc. as well. So coming back to your question, we've seen very robust holiday quarter trends, as we were sort of expecting it as well. It had a slow start, to be honest, early days in, getting into the quarter, starting in October and November until the World Cup. And as soon as the World Cup got over, it just took off. Because people were sort of maybe distracted with the World Cup games. Of course, we got some surge where the India featured games were happening in those particular cities. But in general, over the weekends, people were just watching more cricket than wanting to step out. After that, it took off, and then from there on, the overall booking trends has been picking, and as they would typically do in the holiday season, in the previous years, as we see. Now, specifically to this long weekend, in fact, from 23rd onwards, we have like full peak sort of travel dates. 23rd, 24th, 25th was a long weekend. We have one more coming up on 30th, 31st, and 1st. And we've seen, sort of record breaking bookings happening, record-breaking check-ins happening on a single day. On our platform for our hotel business, we would have seen a record single-day checking in of the customers into the hotels, which would be about 20% increase of the previous peak. And that's fantastic. And similar trends sort of for flight bookings and so on. What happens during this time is that every segment, now minus the work segment, which is understandable, the leisure, the pilgrimage, the visiting family and relatives, all segments all come together, and they come together, all of it together at the same time, and that sort of helps in growth in the bookings. So across the board, we've seen bookings happening and like I said, record-breaking sort of long weekend bookings. Yeah.
Oh, absolutely, and we see that visibly whenever we're at the airports or whenever we're trying to, find rooms at hotels these days. You said 20% over the previous peak. So, that peak was last year, or was that peak pre-COVID? And how much higher are we versus 2019? I mean, the pre-COVID era.
Yeah. No, that's a good question. So what I was talking about was the previous peak long weekend. So like to like, let's say 3 days long weekend this year itself. And if you start comparing it with over 2019-20, which is pre-pandemic, they're also, on top of, let's say, comparing the peak in 1920, we've seen about 20-25% growth from 1920 peak as well. And specifically for, sort of single day check-in, the data point that I was referring to. On an overall, this has been a growth year, and this has been a growth holiday season quarter as well. If you start comparing it with the 2019-20, both in volume terms as well as in the value terms. In fact, a lot more in the value terms, partly because of inflation, partly because of the price rise, as we all know. And, the other part is that it's also sort of, I actually attribute that to a fundamental habit change where people have started to spend a lot more on experiences. And within the experience, it is actually travel. So people have the frequency of travel has gone up. The number of holidays they would typically take in a year have gone up, which is a combination of the short stay vacation and specifically in this at this time of the year, it's actually long duration holiday. It's on average you will have 3 nights to as many. About 7 nights.
Absolutely. Rajesh, you're talking to people who feel it, experience it when we're on our holiday. Even when we're not on our holidays, we're planning the next one or thinking about the next one. So I think, it really applies to all of us here. And the trend has only picked up after COVID. Now, let me ask you the business question. Clearly, the opportunity is huge. The numbers are peaking and the industry is really booming. But what about the business itself? Today there are far more travel operators, aggregators versus say, 5-6 years ago. Make My Trip was the first, but there are more in the market. So how intense is the competitive landscape? And in terms of market share, in terms of strategy, in terms of growth, what is it that you're witnessing? I know, for instance, there's one point on convenience fee that became a bit of a differentiator for some of your competitors. But going forward, what can we expect in terms of just competition in the travel space?
Yeah, sure. No, I think it's a great question as well. So, if you really look at it overall, firstly, if I take a step back and talk about the overall sort of business opportunity in the travel space. So the good news there is that the overall pie is growing. And if you look at from a long-term outlook standpoint, on the back of infrastructure expansion happening, airports expansion happening, the demand patterns are changing. The long-term outlook looks absolutely great. And therefore, there is room for sort of more players in the market as well, perhaps. But specifically, when you go deeper into the competition, and that is the way we typically do it, you have to sort of compare and go deeper to see segment by segment and not necessarily look at it holistically, because, from our point of view, if you see Make My Trip offers pretty much every travel use case. So we are like a one-stop shop. But if you start to compare with some of the others, and look at the business numbers, etc., you would see on a particular specific segment, let's say for flights, domestic flights, which probably is the easiest one to sort of get into because of the unidimensional product. But when it comes to, the hotel segment, the packages segment, the homestay segment, a lot more sort of experiential product where it takes a lot to build that business, which
Right.
we've sort of invested behind. There you will see that the competition is relatively weaker, and we sort of, when we look at the numbers, we end up competing with maybe more global OTAs or the aggregators, as you put it, rather than anyone sort of seriously in the Indian market. But when you look at let's say flight segment, yes, there will be more players in the market, but like I said, the overall opportunity is big, and the flight market is growing. I know right now there's a bit of a temporary constraint. Sorry, just to complete the thought, I was just going to say just the temporary supply side constraint that is happening within the domestic market. But 2 quarters down the line, the outlook looks very positive.
Okay, Rajesh, I have 2 questions, but I just want to address the new listing as well. Let's just put that up. Innova CapTab, I think, has come to the market, and the prices should come up. To just take a look at it. There you go. Stocks at about 500 rupees. It's about 12% higher as compared to the issue price. So that's the latest in terms of listing. We've had 1, 2, 3 a day in the entirety of this week. So keeping in line with that. Today, of course, there's only 1. Rajesh, rapid fire, 3 questions from me. As a percentage of gross bookings, what is the margin you make?
Yeah, so if you look at our reported results, you would see at an aggregate level, on a blended basis, we do 10% at a gross take rate level, and at about 15% at an adjusted operating profit level.
Okay. No, EBIT margin is a percentage of gross booking?
No, EBIT margin is a percentage of revenue. I would say, so if you look at it from the gross booking, it will be 1.5%.
Okay. Do you think, what should we, so you are the early leader, will the online booking space grow at what, 10%, 15% for the foreseeable future? What is your prognosis?
Yeah, so, if you see, Prashant, historically, and I don't think it's changing, it's also a function of, the internet penetration, which that has been growing. Now the gap has to be bridged between internet penetration and e-commerce penetration, specifically on travel. So if you keep some of those sort of macro factors in mind, what we've seen is that the overall travel market grows about double digit, so 10-12%. So if you look at some of the industry reports that have come out, they're talking about 10-12% overall growth for the next 3-4 years of the overall travel market. And our thumb rule for the online market is that you would always see online market growing at a 2x, if not more, of the total travel market.
So around at about 20%, basically.
Yes.
Because there's market share, and of course within that there'll be market share movements, etc. as well.
That is correct.
Any plans to list? Any plans to list here, Rajesh? You're the original.
We don't know.
In the US.
Yeah, no, I know. I mean, see, thankfully the stock in the US market has also recovered nicely and doing quite well.
Yeah.
And we've been listed there for, over 13 years now.
Yeah.
And it's so far so good. I mean, we've sort of clarified that we don't have immediate plans to, but, it will always be in consideration when we feel the need of sort of raising capital, which we don't feel we are profitable today. We have a very strong balance sheet. So it'll be a function of when you really need, and then at that point in time, would we want to evaluate India market or not? Will be a matter of evaluation at that point in time.
You need it, don't need it, but this is the market to do an IPO. I'm listed here. I was just joking, but it's great conversation, Rajesh, and we hope to do more of these. Appreciate you joining us and providing us with a nice sort of summary of what the industry trends look like across the online sort of travel hotel booking space. Of course, you do much more than that now, so one-stop shop, as you called it. We'll take a quick commercial break here. We'll come back. Markets, of course, there's lots happening. So many new stocks into the mix. Mitesh Thakkar will be with us with some technical trading ideas as well. Stay tuned.
CNBC TV18, embarking on a quarter century of excellence. CNBC TV18, embarking on a quarter century of excellence.
Welcome back. So the cut is about 77 to 78 points, about 0.3% lower on the Nifty. Bank Nifty is lagging a little more. Bank Nifty is down about 0.5% thereabouts. So we've got Mitesh joining in to tell us what trades could be like perhaps now. Mitesh, so we are getting that dip. The question is, do you buy now, later? You know, how would you approach it?
Morning, sir. I think, I was looking at 48,050 as the support on the Bank Nifty. And on the Nifty, the corresponding level is closer to about 21,600, 630 zone. So maybe, a bit more lower, we would want to see if there's some support coming in and then take a long position over there. But for the timing, I think, the market does seem like in some kind of a pullback mode. Having said that, the overall bias still hasn't turned negative. So we're still trading with positive ideas on the stock side as well, keeping a long bias unless until we see some kind of breakdown happen. So I think that doesn't look to be a very strong possibility. So, we'll maintain a long bias. On the stock side, I have a buy on BHEL. Keep a stop at about levels below 190. Look for a target of around 200 to begin with. And the second stop on my radar is Container Corporation. Recommend buying here with a stop below 846 for targets of 890.
Thank you very much for that. Waiting for a little more of a dip before he goes out and buys the index. 21,600, 630. We'll get to some stocks on the move. Sudarshan is tracking Venus Pipes for us. Sudarshan.
Yes, so Venus Pipes is one of the top gainers today on the back of positive brokerage note. DAM Capital has initiated coverage with a buy call and target is rupees 1,810 per share, which is nearly 30% higher from current market price. As per DAM Capital, Venus Pipes is an emerging contender in the stainless steel pipe sector with hunger for growth, and it is building a niche for itself in high-margin stainless steel pipe space. Large capacity expansion for the company is now behind, and asset sweating will commence. Also, it is going up the value chain, and healthy balance sheet will drive strong 60% earnings CAGR.
Okay, thank you very much for that. 1810 is the target on Venus Pipes. The stock is at 1422. Get into a break. On the other side, we'll be joined by Amit Uplenchwar, the director at Kalpataru Projects International, to talk about their recent order wins.
CNBC TV18, embarking on a quarter century of excellence. CNBC TV18, embarking on a quarter century of excellence.
Welcome back. Let's put the spotlight on Kalpataru projects. The company yesterday received new orders worth 3,244 crore rupees. For FY25, the company has a vision of revenue growth of 25,000 crores and an order book of 50,000 crore rupees. Amit Oplenchwar, director at Kalpataru Projects, is with us to talk about the business momentum and, of course, the outlook for the new year. Amit, thank you very much for joining in. Season's greetings to you. So let's just do a breakdown of the order that you announced yesterday, 3,244 crores. I believe it's across buildings and factories, residential buildings, etc. Just run us through the flow, because earlier in December also you announced a couple of orders. So in Q3, what's the inflow and which are the segments where you're getting most of these new orders in?
So, Surabhi, first of all, also to all of you and all your viewers, season's greeting and upcoming New Year wishes in advance. These order bookings for us have been across the board. As you know, we have 6 key segments that we operate in, being, buildings and factories, infrastructure, water, transmission, railways, and oil and gas. And if I tell you up to, year to date, we've got orders in excess of 17,500 crores that we've booked already. And we are sitting on a very comfortable L1 position, which, takes our current order book in excess of 50,000 crores, which is an all-time high for us in terms of order booking. We had said that the order booking target at the beginning of the year should be close to 26,000 crores. And I think by the end of the year, we should be achieving that target as we had promised at the beginning of the year.
So Amit, just the second part of the question then, you're saying order book is standing at a healthy 50,000 crores. Your intake so far this year is about 17,000 crores. Is it uniformly divided across the segments, whether it's, power transmission, building factories?
To answer that question, we've got transmission, and so let's start with that, right? Our T&D, which over the last 2 years was seeing subdued activity, has now really stepped up the gas in terms of order awards, announcements, and further bids that are on the horizon, right? So today we are looking at almost 2.5 lakh crores worth of opportunity set in T&D in the next 3 to 4 years before 2031. So T&D has been giving us a large amount of this order book. Close to 35% of our orders are coming from our transmission and distribution business, almost 40%. Our water business has been getting a lot of orders across various schemes of government, be it Jal Jeevan Mission, be it lift irrigation, so on and so forth. Our building and factories division, and as you would have seen in our one of the large orders of our, the orders that we declared today, has been one of the largest projects Kalpataru will be undertaking at 13 million square feet for a private developer in the south. And, so across the board in our urban infrastructure, we've we got the letter of award for our first PBM-based underground metro system project for one of the states. And so across urban infra, T&D, water, building factories, we've been getting orders. And so it's not skewed to any one division, but all of them are giving us this order mix as we speak.
So 17,500 by way of order inflows so far. By the year end, FY24, what could be the total quantum of order inflows and your L1 number right now?
So, we are in a good L1 position. Exact numbers, because we still have to close the quarter, Q3. But I think our target was 26,000. And looking at our L1 position and some of the other tenders that yet to be opened, I think we should get to 26,000 crores of overall order book win at the end of the year.
Okay. And what about your FY24 guidance of 25% top line growth and 8 to 8.5% EBITDA margins on track?
So, basis our H1 numbers and the efforts that are going on, I think our 25% revenue growth at the end of the year is something that we are still working very hard towards. And hopefully we should get there at the end of Q4. And EBITDA margin also, we said we will do between 4.5% to 5% of PBT, Rima, and around, we were very hopeful that we should get to that number also at the end of the year.
Okay, got that. Just a quick word on, good morning sir, Prashant here. On that 2.5 lakh crore number that you said in the T&D segment, that number is essentially the amount of ordering which will happen in the T&D segment all the way till FY31?
That's correct, because there is a lot of renewable energy, close to 500 megawatts, that has to get connected to the grid. All these projects they're already announced. So you have to have these lines ready for you to evacuate these, the renewable energy. So for 2031, 2.4 trillion rupees is something that has been announced, and we hope to get a share of that as well, being one of the largest players in that space in the country.
No, absolutely. And what is the what's your share typically when these orders come up? I mean, is that the way to look at it, or what had historically?
I think it is a
yeah.
So, Prashant, this depends on at what margins people are bidding, and, so I don't think there is a set pattern. But having said that, for very large, complex project in the transmission and domestic space globally, Kalpataru is one of the top players because we operate across very different segments where the competition is limited to, 4 or 6 players worldwide, whether it's 765 kV or 800 kV. So very large and complex transmission line projects. And so, it's with logic, we should get a part of that opportunity set for us.
Okay. Just one last question. Could you update us to what the current debt levels are at and what are debt reduction plans going forward? There was a note from Novama, the broker, I believe, which said that the sale of some transmission assets along with some restructuring, exit of road, BOT projects could actually help you do that. So if you could help us with what the numbers are, what the plans are.
So I think, debt as a standalone number can skew the picture. Instead, what we've been doing, so whilst we've been steadily reducing our debt over the years. But at the same time, when you're growing at 25% on a revenue basis year on year, you also need to do capex. So what we are doing is we are looking at our net working capital days, and to keep that below 100. We are looking at our interest cost on a standalone basis for the core EPC business at close to 2% of our revenue. And this is what we intend to keep at, which is a very healthy balance sheet parameter to see the debt levels of an organization. And we are completely committed to keep our interest rates, in spite of the increased interest rate regime, to be around 2% of revenue and net working capital days of close to 100.
Amit, we leave the conversation here for now. Thank you very much for joining in. The stock is up 10% today, buoyed by the recent order wins. And the company is confident about achieving their FY24 guidance of 25% top-line growth and PBT margins of 4 to 4.5%. But as we approach the end of 2023, veteran banker and founder of Kotak Mahindra Bank, Uday Kotak, shared his reflections on the financial sector in a year-end address. Taking to Platform X, previously known as Twitter, Kotak laid out a strategic vision for India's financial trajectory, advocating for a comprehensive assessment of the sector to propel the nation towards its objectives. In his address, Kotak emphasized the need to prevent bubbles by employing a multifaceted approach involving policy, regulation, education, and issuance of high-quality financial instruments. He also highlighted the widening gap between the highest marginal tax rates on debt and equity, emphasized the need for a reconsideration of the double taxation on dividends, highlighting critical areas requiring immediate attention. He underscored the urgency of reforms in acquisition financing and streamlining of the Insolvency and Bankruptcy Code and the National Company Law Tribunal process to fuel India's aspirations for growth.
All right, let's talk about Tata Group now. Chairman N. Chandrasekaran has asked employees to brace for more disruption and volatility in the new year. In his New Year message to employees, he highlighted that 40 countries are heading to polls in 2024 and complexity in global governance will reach new heights as the world attempts to regulate data privacy, artificial intelligence and carbon emissions. In his New Year message, Chandrasekaran also said that India's future is bright. Amidst all the uncertainty, he identified 3 areas for the group to prioritize: execution, customer satisfaction and technology.
Well, with that, it's a wrap on Bazaar. From the entire team, thank you for watching. Up next is Chartbusters.
CNBC TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Oil marketing companies like HPCL, BPCL and IOC decline anywhere between 2 to 3% on the possibility of a fuel price cut on the back of crude prices cooling off. They are reports.
GAIL shares surge over 2.5% and the stock hits a 52-week high as Motilal Oswal issues a buy call expecting the stock to re-rate to a price target of 195 rupees a share as earnings visibility improves.
Innova CapTab makes its debut on the exchanges, listing nearly flat but has since gained some ground. In fact, the management will be joining us shortly to discuss the company's post-listing plans.
Venus Pipes surges as DAM Capital initiates coverage with a buy rating and sets a price target of 1,810 rupees. The stock is up 4.5%.
Techno Electric surges after the company wins a 1750 crore rupee order to provide transmission and advanced metering infrastructure.
Hello and welcome. You're watching Chartbusters on CNBC-TV18, the last one of 2023, the final trading day of the month, year, quarter, whatever you'd like to call it. And what a year this has been, right, Mangalam? And the index is up almost 20% this year. And if you exclude the COVID year, as you were highlighting yesterday, it's the best year since we have had in almost 5 to 6 years now. So, and today we are seeing a bit of cooling off after the kind of run-up that we've had. The index still is up close to 2% for the week. So 21,700, we're trying to fight those levels, holding on to those levels. We're up 20% this year. But there are two key levels that I wanted to highlight. One of them is a little far off from here. The other one is 21,828. And that level would mean that the index has now gained 5,000 points from the lows of March, the 16,828 low that it made. And to show the kind of year that we have had, Mangalam, and if you take the tops that we have made this year, whatever tops that we have made, the correction that has come from the top has been hardly in the range of 3% to 5 to 6%. We have not had a substantial correction at all. So that shows the kind of year that we have had. The early part of the year was a little bit volatile. We were mentioning the January seasonality yesterday as well. Rohit Srivastava highlighted this, and we also did a bit of research, and we found out that 7 out of the 10 January months and 6 out of the 10 February months over the last 10 years have been negative months. So yeah, it's been a fantastic year.
It's been a fantastic year. You know, what's interesting is that over it's the 8th consecutive year of positive gains for the Nifty, and on a compounded basis, the Nifty has, grown at around 13% on a CAGR basis for 8 years. And these weren't easy 8 years. We had a pandemic, we had demonetization, we had 2 wars, we had GST implementation.